Good afternoon, everyone. This is Todd Blickenstaff. I'm the um, president of the and program coordinator for the Portland PDX chapter, Portland, Oregon, and we also uh, manage the national AAII income and cash flow SIG group, what we were presenting for today. And so I'd like to welcome everyone this afternoon. Thank you for taking time out of your busy week to be here. And just wanted to say a little bit about that. I'm here with the co-coordinator, if I can say that, of the Income and Cash Flow SIG group, and that is Gilbert Ho, who's also one of our presenters on the call today. And also we've got John Wong, our able webmaster, on the call with us, and our special speaker, Andy Profit, who's got a lot of history with our group. So what I'd like to say to everyone is we recommend that you have questions that, and Gilbert, you normally take those at the end of the presentation, right?
I can do either.
For your portion. Okay. All right. Well, we'll gauge that. And we recommend that everyone, if you've got questions during either of the presentations, the first presentation will be managed by Gilbert Ho, and the second one will be Andy Profit. And please put your questions in the Q&A section, not in the chat section, but in the Q&A section, because we can pull those up and present those, and I'll be culling through those during the presentation, and we'll be going from there. I did want to mention we do our meetings normally monthly, but sometimes they're every other month, and we keep people appraised of that. Our next call should be on the of July. Excuse me, of August. That should be August 21st, and we'll let you know what our presentation is going to be for that meeting. And we always tend to have Gilbert doing his presentation that on the outlook for the markets and the economy that he does on a monthly basis. And we've kind of kidnapped Gilbert from the Silicon Valley chapter to be with us on this meeting as well. And let's go ahead, in the interest of time for everyone. Let's get going on this. And Gilbert, why don't you go ahead and queue up your presentation and take it away?
Okie dokie. You can hear me okay?
I can hear you. Mm-hmm.
Cool. All right. So this is only economic review because I don't want to predict market. Well, this is a summary of the latest economic data. It allows the audience to form their own informed viewpoints rather than be driven around by media. Okay, so all right, the disclaimer, basically, this is for entertainment purposes only. Data may be incorrect, and we're not selling any kind or giving any kind of investment advice. And if you lose money based on anything here, you're on your own. I do have a slide convention which tells you what are the stuff in the slides sometimes means, like dates and URL stuff. All right, so Fed FOMC had a meeting last month, and here's a summary. Basically, they keep the rate the same. They continue to do quantitative tightening in a slower pace. In their survey of their members, which is the summary of economic projections, SEP, they are predicting, or the consensus is we will have lower GDP growth. In unemployment rate will be slightly higher, and inflation will be slightly higher, and there is a room for a cut. However, they're debating, they're hesitating because of the trade policy concerns. The next meeting is the end of this month, July the 30th, and it is unlikely, in my personal opinion, it's unlikely that they will cut rate. All right, so the interest rate by maturity, looking at from 1 month to 30 years, there's 3 lines here, which is from beginning of 2022, which is the yellow line below, and we are in the red line, comparing to the blue line, which is the beginning of last year. We can see that short-term rates has dropped in the last year and a half because due to a monetary policy. And long-term rate has going up, and you can thank that to inflation expectation. In terms of rate difference, also called yield spread, if you, I think the more reliable one is the 10-year versus 3 months, and that's the purple line, and it's being flirting with inversion, which may, the inversion usually indicating coming recession, although it didn't quite work every time like we had previously in the 2023.
Hey, Gilbert, I've got a question myself in terms of interest
Sure,
rates. I was
sure.
wondering this today, the old controversy of Trump wanting Powell to cut rates. He wants him to cut rates 3 percentage points, which is pretty significant. And if it'll be interesting, I would imagine one of the Fed's determining factors is how does the long portion of the yield curve going to react if the Fed, which traditionally has only been able to impact the short-term portion of the yield curve, if they start cutting rates, will we actually see an increase in long-term rates if and when they do that?
Well, that happened last time, right? Last time Fed cut the short rate and the long rate went up. And
I believe that is correct. Yeah.
So there's a lot of talk about this Trump versus Powell, but I think Fed, as it stands right now, they just have 2 mandates, right? Unemployment and labor market and inflation. So that's what we're going to cover here. And until the administration get somebody, a yes man into a Fed chairman position, I think hopefully we're okay. And Fed independence has been a pillar of financial market stability. So if that gets destroyed, then, I don't know what to say.
Yeah. Thank you.
Sure. So looking at the 2-year Treasury versus the Fed fund rate, the 2-year Treasury usually means what market's expectation of the Fed fund rate is. So when the purple line is below the red line, that means there's room for cut. And so that's what the market's expectation. And looking at quantitative tightening, the purple line is actually the Fed balance sheet. And you can see that it went up crazy and then it's coming down slowly. The orange line is actually M2, and you can see that M2 hasn't grown since 2022. So they're continuing doing that. As of end of June, they reduced almost quarter of their target. A quarter of the balance sheet, and their target actually is higher than 31%, but still, that didn't seem to have impact to the market, as you don't hear anybody talking about it. Yep. Okay, looking at the 12 months commodity prices, commodity future prices, we can see that gasoline is in the range, in the 12 months range, in the middle of it. Natural gas actually is at the high end, upper end. Copper, due to the 50% tariff starting August 1st, has a price jump. Corn is in a downtrend, but beef is on an uptrend. And lumber, surprisingly, it jumped up, even though the home builders are stressed. So that's if you look at this, there's a lot of inflation pressure here. The inflation indicators, we have the producer price index this week, and that's the purple line, and it seems to be 10. The conundrum here is the red line, which is negative. So the import price index shows an annual decline despite the presence of certain tariffs. And we all know tariffs is a tax That's amazing that the import price index is year over year is negative, with some tariffs already in effect.
But most of these tariffs are not quite in effect or haven't made their way into the data, or at least the current data versus the futures markets at this point, right?
That I don't know, but
Okay.
if you look at the actual inflation index, the CPI and the PCE, CPI is what we experience, and PCE is what the Fed used to decide inflation, the trend of the inflation. So the latest CPI has an uptick, and sizable uptick, and we will get the PCE end of the month. So some people say this is already started to reflect the whatever tariffs is already happening, right? They already collect a lot of money from tariffs, so it is happening, and we shall see. And then with this is trying to see what happens with inflation in the future. University of Michigan has a survey, which in the long run, if you go back to the 70s, all the way go back to the 70s, they are pretty closely correlated with the CPI fluctuation. And so once again, if you look at 2021, that is the case. So the shocking thing is okay, so there was the government data only shows has a 1 month delay. So I actually put in this down arrow that you just saw. So basically, we have this spike. It surged. The expectation surged to 1981 level during April and May. So you saw that spike up, but then sharply dropped to 5%, from 6.5% to 5% in the month of June. So their official number, final number, is end of month. So end of July, we shall see if this is really a thin spike, or a more wide stuff. But it's a warning sign.
Mm-hmm.
Looking at supply chain, which drove some inflation pressure in 2021. It is good to look at this, and because some people say tariff can squeeze the supply chain as well. Now, so those were the inflation indicators, which is half what Fed looked, and then the other half is the labor market. One of the important data is the job, the JOLTS, the job. So looking at job opening, and that says like there are still more openings than unemployed, which is kind of rare.
Mm-hmm.
And you look at the whole spectrum things, the purple line is the number of job openings. I mean, the rate of the job openings, and that is healthy. We're not crazy like in the 2022, but we're back to still, if you look long term, we're on the upper end. And then if you look at the hire rate and separation rate, it's good because the green is above the red. And then if you look at the quits, which is people voluntarily leave, meaning jumping jobs, hopefully, that is back to normal. So we can say that the labor market is normal. Now, if you look at the employment data, from this morning, the unemployment insurance claim, both the initial and the continued unemployment claim is pretty low historically, compared to a long term, even though in this scope they're not at the bottom of it. If you look at month to month change in terms of employment, to me, it seems to be healthy. We're not going crazy in the 21, and we're not going negative, which means we're firing people more faster than we can hire. And if you look at the unemployment rate and labor force participation rate, they're stable. I call them healthy. And if you look at the weekly income, which is taking the earning times the hours worked, the annual change is still above the CPI, which is, I would say, healthy. Finally, look at the high-tech unemployment using Silicon Valley as an example. The high-tech unemployment rate is on a downtrend, matching, I think it was 3.8% or 3.9% in June, which is, maybe it's the calm before the storm because it's rumored that AI will replace all high-tech jobs.
Well, I wonder, Gilbert, I heard somebody speculating recently on that actually AI itself is going to be a big growth field in the coming years. So that will actually has potential to generate jobs as more and more investment goes into the AI sector. I haven't not seen any figures how these these two trends might offset each other. One, whereas AI advances and takes away more perhaps manual jobs that were done in the past, but then how much is going to be invested to grow the AI sector of the economy? Have you seen any figures like that?
Uh, there are very smart people on Wall Street trying to estimate that. I might have to run into some data, but I don't remember there is a clear consensus or as to what it's going to be doing. But I think in general, AI is how do I say, we learn how to use human civilization advance based on tools, and AI is a big tool. It definitely, I think, is going to be a constructive destruction or something. Like you're going to have people lose job, but then you're going to be hiring people who can use this and do better things. And so AI to us a lot of times just means the LLM, large language model, but then you have so-called physical AI, which is like self-drive, robotic, and so I think if the past is in any example, then we probably end up creating more jobs than losing jobs. Hopefully that's the case.
Thank you.
Okay, so looking at ISM manufacturing PMI, in the past, anytime you're below 50, the economy is contracting. But I don't know if it happened because this is being below 50 since 2020, later 2022. So people say we're not manufacturing economy, we're a service economy. So service PMI is important, and it does show that we are still above the 50, which means that we are still expanding. We're in the expansion, I guess. This is a indicator based on GDP that shows the sort of consumer or economic activity. It's called private domestic final purchases. I take it as similar to retail sales as a way to gauge the economy. And this is quarterly data, and annual change showed that it's pretty stable right now. Finally, the Atlantic Fed GDP now, which is a real-time guesstimate of the GDP, is at 2.4% as of today. So that's healthy. Leading economy indicators used to be really reliable in predicting recessions, even though it may be way ahead of the time. However, like a lot of other indicators since it didn't work in the 2022 signal, which says recession is coming. So unfortunately, now it's triggered again. Like I said, it has a long lead time. So this puts 2026 economy in jeopardy, I guess. So something to keep in your mind. All right, so this may be, next two slides may be controversial because we are talking about government debt. So deficit as a percent of government income, as you can see, we rarely has positive. We rarely has surplus. Deficit seems to be the norm. And maybe that's the feature of a democratic system where the politicians always try to appease the people. And total debt as percent of GDP, everybody's familiar with this. This compares many countries. We can see that China is catching up, and China's the rate of increase is the highest. Germany was very conservative, and hopefully they'll spend some money, buying some weapons to protect themselves. And
Gilbert, I'm just trying to read the color coordination here. I think that China is the red
yeah,
bar, and then the U.S. is that purple bar?
yeah,
Okay, so
yeah, yeah. So I
all right.
didn't include China. I mean Japan, because Japan's way up there. But so the thing is, ballooning public debt is a worldwide phenomenon, and so everybody's saying that this spending bill they just passed is creating a lot of deficit, but the question really is, will tariffs eliminate the deficit from this one big beautiful bill act? All right, so people say that is not good. Just think about a house, how you live day to day as a household, and so consider this: if your net worth is 16 mil, would carry 4 mil debt seems like a significant issue. What do you think, Todd?
Well, yeah, I would think so. I mean, that's 25%.
Okay, so people carrying 25% debt, depending on your age, that may be okay, maybe not, right?
Hmm.
So I would say, maybe concentrate on the growth rate of your net worth is a better measurement. And so on that theory, we look at the United States household net worth in blue and federal debt in red, and the household net worth in green. So what I'm trying to say, if you look at the growth rate of the green line, that's not a bad slope, as long as we keep it that way. And so that's my view of deficit. Of course, we should keep it low, but we don't want to go extreme. So yeah.
Yeah, I should mention one thing because I saw an editorial in the Journal, Wall Street Journal, earlier this week that talked about the fact that, okay, because the government was, I think Trump administration was presenting, hey, we had a month without a surplus, without debt, but they said statistically it looks like although the revenue from tariffs to the U.S. will help reduce the deficits, it's not going to put a significant dent in the total deficit picture.
Right, right,
I think,
right.
yeah, yeah.
I think the big beautiful bill and tariff is a washout. Basically, they are not increasing the debt, they're not reducing the debt. So
Yeah.
okay, so look in the world stock market, and this is almost a 3-year chart, and this US is on top for sure. But if you look at it from 2025, the best performing region, I'm trying to do the 7 continent. Of course, there's Antarctic doesn't have anything, but the best performing this year is Europe, and similar to it, or number 2, or is, guess what? Africa. So go figure. Anyway, that's all I have. And please remember, this is for entertainment and it's not investment advice. Also, we're looking in the backwards in the rear mirror, and the market is actually looking in front of us.
Hmm.
And then finally, the things that never happened before happen all the time. So don't be surprised with stuff. That's all I have.
Appreciate that, Gilbert. Yeah, and I think when you showed the Europe has done very well, I think a good chunk of that is due to the decline in the dollar versus the euro year to date. That
10%.
yeah, we've had a pretty significant decline in the dollar versus the euro, so that's contributed to pretty healthy returns in Europe versus domestic equities. And I know we have one question that was put in the Q&A section. with the, and I'm going to read it verbatim, with the recent jobs report showing 170,000 increase in number of jobs created. And with tariffs about to hit, how can the Fed even consider rate decreases now, even though Trump is, pounding the table on this? Because these are not recession-like numbers. I guess I'm adding my editorial here to William's question that he input. So if you have any comments on that, Gilbert.
Uh, my take is if you look at they're not going to cut rate July, and then they don't have meetings in August. They have a Jackson Hole meeting usually, and they'll
Oh yeah.
make some announcement. And then they come September, people saying, okay, they're going to cut rate in September, but I don't think so either. But the market, I don't think the market is counting on rate cut anyway. So as long
Okay.
as the hope is there, I think market will be okay.
Andy Profit is here in person online with us. And I'll give a bio on him in just a second, but we're actually going to present a recording of a presentation that Andy did very recently to another chapter. And we're going to display that because, and I believe the presentation is in there. And I think there's also some Q&A section, Andy. I think it's part of that presentation. And then we're also going to encourage the attendees here to continue to enter questions in the Q&A section. So we're going to have a bit of a recorded Q&A section as part of the original video that Andy did here just a couple of months ago. And then we're going to also take questions from audience members that are here on the live call. So that gets kind of complicated. But I wanted to just say a little bit about this, about the background. By the way, and I didn't fully give Gilbert's bio, I wanted to also mention Gilbert's a retired software engineer with development management experience at various startups and large companies, in addition to his work and investments. And wanted to pivot now to Andy Profits. Now, Andy's got great history here. Andy was the father of the original income and cash flow SIG group that we did in Portland before we kind of gravitated to doing this on a national scale. When AAII National asked Andy to kind of take the lead here in presenting this, and then when we went online, he kind of handed the baton to myself and others that are support that. But we're really excited to have Andy present to us as he did in history in Portland. And he's a longtime student of investing, who's been an active member of AAII for 35 years. And he's been on a journey to build a steady, growing stream of dividend stocks to help he draws on his management experience in business and engineering to construct a plan. And what his purpose is one of his goals is to sharing by his personal endeavor, hopes to educate our membership and how he uses dividends for retirement income. So Andy's approach with equities is really dividend production, and that's why we're featuring on this call, because that's what we focus on with this group is income and cash flow. Andy also has spent 45 years in the high-tech industry, first as design engineer and later as a senior manager, and his final position was the executive director of a trade association. Andy holds an MBA as well as an advanced degree in electrical engineering. And so we're going to start the recorded video now and then progress as we discuss, but keep those questions in the Q&A section coming, and we'll answer those as we go on. So let's go ahead and roll the video. I think Gilbert's queuing that up right now.
Topic.
I'm not an investment professional by any means, and so everything I say, you should take with a grain of salt, because I'm just an amateur trying to figure out my way through dividend investing. So, this is me looking for opportunities in stocks, dividend stocks. Sometimes you find some junk, and sometimes you find some stuff that's on junk. And of course, the usual disclaimer, of course, is that I'm not an investment professional, and I hope that everything I say here can be taken with a grain of salt. Um, you know, you really need to do your own homework. This is not something where you can expect somebody to give you some stock advice and go off and do it. You know, we expect you to do your homework. So, just a shameless plug for the Portland chapter. I don't, I'm not involved in the Portland chapter directly. Um, I used to do the income SIG for the Portland chapter, but I dropped that just before COVID hit the whole entire country. But Todd Blickenstaff, who is our president with the local chapter here, has restructured the Portland chapter so that we are a national income and cash flow SIG group. And so he does presentations on a wide range of topics. Um, you know, I think every month or every 2 months. So, you know, if you want to sign up on the mailing list, just go to the Portland chapter, which is shown at the top of your screen, and and then you know enter your information, and so that way you'll get notices for upcoming meetings and so forth. All right, so quickly the agenda. I'm just going to go through some of my income goals that I've been using for the past 20 years and so forth, and the vehicles that I've used. And then I'll say a little bit about passive versus active in investing, and then dividend guidelines that I use, particularly for the stuff that I invest in, and then some resources and tools. And then, of course, I'll say a few words about taxes because you know they do affect dividend investors. And then I'll have some closing remarks. And I've included some references in the handout material. So, you know, if anybody wants to do some more homework, I would recommend the references. So, okay. What I'm looking for is I'm retired. I'm 88 years old. And so I'm looking for a steady stream of income. I'm not interested in growing the portfolio too much. So I'm looking for a steady stream of income, and I'd like it, of course, to grow faster than the rate of inflation, and you know, preserve capital, um, and then optimize the after-tax income that's available um, to me. And I kind of try to shoot for a CAGR, a compounded annual growth rate of somewhere between 8 and 10%. The S&P 500, I think, is around 8%. So I try to do a little better than that. Uh, Although lately, I think that's been a bit of a struggle. But I'll go into a little bit more about that later on. Okay, and this is what I typically have used in the past as my income investing choices. Now, because there's so many topics on this income stream investing portfolio, I'm just going to concentrate on dividend investing right now. There's obviously all these other approaches that can be used, and you're welcome to try some of them. The more you learn about them, the more you'll see that that's a benefit to you. So I'm going to just concentrate on dividend investing right now because that's the simplest and the straightest forward way to invest in and get a steady stream of income. And all these other approaches are perfectly fine too as well. And just a quick note about the approach that I use. There's kind of, I think, four ways of investing for income. You can use what's called a passive approach, which is, you know, you buy a mutual fund or an ETF, and and then you monitor it and do some work on that. And then some people use a combination of a newsletter, dividend newsletter, for example, and then they use a passive style by just investing what the newsletter requests or tells you to do. And then there's a more proactive style, which is what I tend to do over the years. And it's really, really important to keep accurate records. And then I usually kick the tires on my stocks twice a year, maybe even quarterly on a quarterly basis. So I tend to be on the more proactive side. And so, weekday mornings, I'm at my computer, kicking tires on various stocks and trying to figure out what's undervalued and what's overvalued and so forth. Okay, so I'll just go over these ETFs because I do have some ETFs. In fact, since I have an account with Schwab, I use the SCHD, which is their dividend ETF, and it's fine. I mean, it works fine. The problem with it, of course, like any ETF, is that you take the good and the bad when you're buying an ETF, and so it gives you an average performance, which is fairly close to the S&P 500. So um, what I try to do is I try to buy it when it's undervalued, and so I do have some portion of the portfolio which is in SCHD, but I'd say it's a fairly small percentage of the entire portfolio. But for a passive investor, ETFs are fine. I mean, they're a good way to go if you don't want to spend the time on it. So, okay, and then quickly, just to give you everybody an overview of what these ETFs will do. If you looked at the S&P 500 and you looked at just the aristocrats, which are the dividend stocks that I think have been um, paying dividends for the past 25 years or so. For example, Nobel, which is NLBL, it does that very well. And you can see that here that they do beat the rate of inflation quite a bit, by quite a bit. And so they're a good vehicle for a retiree. And they do compensate you a little bit for inflation and so forth. Okay, so let me take a moment here to make sure everybody understands what a portfolio of stocks is made up of. I think that corporations, if you looked at all 47,000 of the companies that are publicly available, there's only a fraction of that which are what I would call mature companies. In other words, there are companies that are, startup companies on the left here, and then you have your growth companies, and then the mature companies are at the peak here, and of course there's companies that are actually in decline or are going to close out their businesses basically. So when you're looking at a dividend stock, I tend to concentrate on the mature companies. These are people that are, these are like AT&T or Pepsi or Hershey's or Procter and Gamble. They're not companies that are startup companies or growth companies. I would consider, for example, NVIDIA, a growth company and a great company, of course, with great opportunities and so forth. But, you want a steady stream of income. And these growth companies tend to be plowing back a lot of their capital back into the business so that they can grow. Whereas mature companies tend to be mature and they're already established and their structure and so forth. And so to that end, the revenue growth is pretty much the close to what I would describe as the maturity of the firm. These companies have a tendency to grow at somewhat around the economy. In other words, they'll grow 5 to 7% or 8% per year. Their margins are well established, so they tend to have some sort of a competitive advantage of some sort, and it can be, a significant competitive advantage as they move forward. They tend to borrow more money than the typical startup company or growth company. And it's because they're more attractive to banks who want to lend money because they're a little more steady in terms of their cash flow and so forth. So they tend to borrow a little bit more money. And the cash buildup in these companies is fairly large, and that's why they pay dividends. In other words, they build up their business. They end up with more projects that they can't find enough projects that will cover their hurdle rate, so to speak. And so that's where where the dividend comes in. And so they generally provide cash back to the shareholders, either in the form of a dividend or a buyback, basically. And they tend to be inorganic growth. So they tend to, a lot of these mature companies will pretend like they're teenagers and go out and buy other companies, or may sell a division that is not profitable for them and so forth. So that's typically the characteristics of these mature companies. Okay. The way I approach a company or do an investment is I use what's commonly called a discounted cash flow approach. In other words, what I do is when I look at a particular company, I look at the cash flow from the company. Either that's in the form of earnings or in the form of dividends. And so what I'm trying to do is to take the cash flow that may be in, say, year 1 and year 2 and year 3, and I discount it back to the current price or current value. And this discounting process is gets fairly technical, but it's basically an approach that uses what's called a valued approach or a fundamental approach. So in other words, you're buying an entity and you're looking at this future stream of cash flows and you're discounting it back to the current day at price, and then you determine whether that's undervalued or overvalued. And so I use two approaches. I use what's commonly called the discounted cash flow, which is basically looking at the present value of the cash flows that a company has. And then the other approach I use is I use the dividend discount model. The dividend discount model is simply you're looking at the dividend operation from the company, the cash flow, the free cash flow from the company, determining how much of that free cash flow is going to be distributed back to the shareholders. And then I try to estimate how much that cash flow will grow over a given period of time, usually about 5 years, as best as I can do. Now, a word of caution about doing this kind of modeling. Every time you do a model, you develop a spreadsheet or whatever, you're going to be wrong. It's just there's no way about it. No way about it. For example, recently I saw an analysis of Pepsi done by a professional analyst community, and every one of the estimates for the stock, the price on the stock, the valuation was off, was different. And that's because there's so many variables that can be that are judgmental variables. It's difficult to get the exact number. And so you need to revisit your portfolio and your stocks on an ongoing basis. And so that's what I do. I look at them usually on a quarterly basis or semi-annual basis. Now that doesn't mean you have to look at every one of them. Just the ones that are where you think you may not be achieving the growth rates or the rates of increases that you want. And so I'll go over a little bit more on that a little later. So here are my guidelines. I try to go for a growth rate somewhere between 9 and 10% if I can get it. That's a little difficult to do in today's market, but in the past, it's been quite achievable. And then I use primarily dividend stocks that are probably paying somewhere between 2.5% to 3% yield. And then I try to find companies that will pay, somewhere between 6 to 8% in the growth of the dividends. So in other words, the combination of the growth and the yield is somewhere between 8 to 12%. If I can find that, I'm a happy camper, so to speak. So, and then I allocate the portfolio. My rule is somewhere between 2.5 to 3.3% of the portfolio is in any given stock. Many years ago, when I was still working in Silicon Valley, I bought Intel in the 1980s, of course, and of course that in those days Intel was doing very well. So it became a huge part of our portfolio, and so I had to sell a lot of it to get myself down to 2.5%. So that can happen to you if you're buying a stock that has a large growth rate. And then I try to diversify across industries and sectors. I usually try to do this on a portfolio basis, and so this is kind of beyond the scope of my presentation today, but I can go into that sometime in the future if needed, if we can talk about that. And then I try to keep the portfolio to somewhere between 25 to 30 stocks or entities, mostly dividends. I do have some REITs. I have income realty, basically, and I've had some MLPs in the past. And I do own some preferreds. I find preferreds to be a very attractive area right now. But I won't go into too much there because that's an hour's presentation all by itself. So, but the portfolio is mostly dividend stocks. Okay. Here's the guidelines. The past dividend growth is suggests the performance. In other words, these companies are mature companies, and so they'll grow their dividends, approximately the same rate at which they've done in the past. There's some variation on that because you have to look at the free cash flow to make sure that they are now continuing that. Some companies can get into trouble, and their cash flow can drop dramatically. And then just to make sure everybody understands, there's some tax implications with dividend stocks because the bottom line is how much money do I put in my own pocket so that I can spend it on, my life, so to speak. And so if you're buying a dividend stock and your tax rate, let's say, is you're in the 15% tax bracket, then, oh, excuse me, in the 22 to 24 tax bracket, and you're filing on a joint return, that dividend is taxed at 15%. That's quite a bit lower than what you would normally have for ordinary income. And so dividend stocks, qualified dividend stocks, are a fairly attractive approach for a retiree. And if you're doing it in a tax exempt account, well, of course, that's even better yet because it's untaxed until you actually take your RMD. So dividend stocks are a very attractive approach for an investor, especially a retiree. And then I have some selling criteria here that I use for dividend stocks. You know, if they cut or suspend the dividend, then I'm out basically. Usually, and then if I look like the stock is going to be in a bubble, so to speak, then I'll dump it basically if it's fairly high and overvalued. And then if there's a fundamental change in the company, I'll do it. For example, I was looking at Hershey's. You know, Hershey's. You know, I don't know if you follow that particular stock. Is that they get most of their cocoa beans from West Africa, and the weather there, I guess, had an extreme situation, and so the suppliers of cocoa beans declined dramatically, and so of course Hershey got impacted by that, and so it forced me to sell that particular stock, which was a very attractive dividend paying stock, and so you know that kind of fundamental major issue can really impact you and so forth. If they announce a split or separate entities, I generally see that as a flashing red light or a warning, a yellow light. And so I take a hard look at it because, you know, if they spin off some particular division, that division might be one that is very profitable or maybe one that they don't want to or has marginal results. And so you have to take a look at it. If the cash flow dips, I take a very hard look at it. Probably the most important one on this list is the management. If the CEO leaves the company for whatever reason, or the CFO leaves, that's a flashing yellow light in my judgment, because you don't know who is going to be taking over, and you never know for sure how they're going to manage the overall direction of the company. So I usually watch that very carefully. If the yield drops below 2.5%, or is above 9%, then I take a long, hard look at it, because I think that's, you know, I don't like chasing yield, basically. And if the current yield exceeds 10%, it's generally just drawn profit from the portfolio. I don't use any margin. I don't use any shorting. I have done some options in the past, covered calls, and I may do that in the future. But I don't do anything right now, to be perfectly honest. And I certainly don't use futures. And I review the portfolio maybe 4 times a year. Okay, so here's where I get my resources. I subscribe to some of the newsletters. There's a Morningstar newsletter called the Dividend Investor, which is pretty good. I subscribe to that one. I subscribe to the AAII one. I use Seeking Alpha quite a bit. And then I use the Kiplinger Income newsletter. And the local library here in the Portland area I see this is backwards. This icon. Makes available value line for online for all members of the library. And so I use that quite a bit because, and once a week they'll publish two portfolios, one for high income and one for steady growth portfolio. And so take a look at that every week and see if there's anything new there that might be attractive and so forth. So, okay, here are my tools. I use Quicken Premier, and to be perfectly honest, it's kind of a love-hate relationship. It's kind of a bookkeeping system. It keeps track of my equities and all the dividends that they pay. And basically what I do is I set it up so that it goes out to the brokerage accounts and pulls in the transactions for all 30 of the stocks in the portfolio. One other thing that I like about Quicken Premier is that it uses what's called an IRR calculation. And that's very, very important when you're doing dividend stocks. In other words, what the internal rate of return is that if you buy a stock and then you have a stream of dividends that come to you, and then there's the current price of the stock, that internal rate of return is very, very important because that has to be, for me, at least 10% or better. And so Quicken allows me to do that very, very quickly. I just go out there and have the brokerage if it fetches the information from the brokerage account and tells me right away if a particular stock is in trouble or something in terms of cash flow. The Value Investing IO program is a discounted cash flow program. In other words, what it does is it allows you to download a spreadsheet with all the requirements, all the fundamentals in it, so that you can do a discounted cash flow to dividends or discounted cash flow to equity. And so I use that pretty regularly when I'm trying to value a stock. Seeking Alpha, I think many of you are familiar with that. It has lots of places that you can go to. For example, there are a lot of analysts publish information there, so you can go to a particular stock and look at what the analyst community is saying about the stock. I use it pretty regularly. And then one of the important other, I use Fast Graphs, which is a fundamental analyzer tool. That's a very good program. I highly recommend it for anybody who wants to do any kind of investing. And then, of course, I use Google Sheets or Excel. And I have a Schwab account. And so if I'm buying or selling a particular stock and I want to find out what the technical indicators are, I use the market edge portion of the Schwab account to track what's going on there. And then, of course, I use TurboTax. Lately, I've been using Gemini Advanced. I signed up for that. And what I use that for is primarily the quickly accessing the management statements and their forecasts of what's going to go. I just plug in the company's name and what its estimated commentary is, and it comes back with what their latest version of what they think is going to be happening. So it's been a helpful tool. Just a quick note on I keep a journal. The journal is a little dated now, and it's a kind of it used to be a loose leaf binder where I had one each stock. And then what I would do is I would write down why I bought this stock and why and when I would sell it. In other words, I would write that down the first day I buy the stock. In other words, I would buy the price I would buy it at and what my line of reasoning was. And then also at the same day, I will write down when I would sell the stock if I got into trouble and it was not working out the way I thought it would be. And that's worked very well because it gives you a perspective on a particular stock, and you learned quite a bit from doing that. I'm trying to migrate that over to Notebook LM. So quite frankly, the jury is still out on that in terms of trying to do that. Maybe sometime in the future we could talk about that. But right now it's I find that Notebook LM is a very good source, possible source, because it's a repository of information that you and only you have access to, and it does all the AI analysis that you want it to do. And I put in there a lot of fundamentals as well, not just the journal stuff as well. Okay, just a quick thing on the taxes. I've flagged Oregon has a very high tax rate, 9.9%. So if you're in a 24% bracket, let's say, and then or you're buying dividend stocks, and your dividend stocks are taxed at 15%, you have to remember that Oregon is another 10%. So that's 24% of your income is taxed basically from your pocket. And so that's a big issue. And that's probably true for some of these higher high income states as well. California probably is one of the highest. So take that into consideration when you're doing your analysis on stocks. Just to finish up here, thing. This is a chart that comes from David Lebson's journal at the AAII journal in 2011. And basically, and I've noticed this with some of my older friends, their mental capacity does decline. And so you better have a migration path that allows you to move your portfolio to someone who's more qualified and competent to handling the portfolio if, God forbid, you're ever at a point where you cannot manage it yourself. And so I highly encourage everybody to figure out what they're going to do about that. Maybe it's somebody else in the family, or maybe it's a professional advisor, but you need to have some kind of a way to do that on a regular basis. Just you don't know what's going to happen in terms of when you get older. Okay, closing remarks. I think it's important to be patient and realistic. There are some risks involved. The higher you go, the higher you go in yield, the more you're going to be more risky, and it will be more volatile. And there are medical expenses that will come up that I'm sure you've never anticipated, and so you need to be prepared for that. And taxes don't disappear; they continue to affect you. Well, that's it. I don't have anything else. I hope that wasn't too much time. I'm happy to take questions, but
So thank you, Andy. That was a very helpful presentation, and we do have a few questions in the chat. The first is, I have AT&T, which was left to me by my mom 15 years ago, and I believe Motria, is it MO, which I bought a year ago or so at a 10% yield. Both have appreciated a lot. Can you tell me what you would do in these cases?
Yeah, I own AT&T myself, and I also own Verizon. And AT&T, it pays a very, very nice dividend. I think it's like 7 or 8% now, I think. And the problem with AT&T and with these utility companies, especially communication companies like AT&T, is they're heavily leveraged. They borrow a lot of money, and so they use that leverage to make their business more competitive, so to speak. I continue to own AT&T. For a while there, I thought I would sell it, but as long as it provides me a cash flow, I'm fine. The company has recently started to reduce their debt structure quite a bit. They sold DirecTV, I think, which was which was a chain around their neck, so to speak. And so the result of that sale is they've slowly started to reduce their debt, and so they're much better shape now than they were a couple of years ago. Now, turning to Verizon, is still heavily leveraged, and that is a problem. The valuation on that, the dividend is very attractive, of course. It pays a nice dividend, but in terms of valuation, frankly, for me, it's underwater. And so if it reaches a point where the internal rate of return for that particular stock drops below 10% for me, then I will probably sell it. But AT&T, I'm continuing to hold, to be perfectly honest. Thank you.
Got it, Andy. Can you comment on Altria or Philip Morris?
I don't have Altria. I have not looked at it. And Philip Morris, I don't have either. They are both very attractive dividend paying stocks. I have friends who own them and have done very well with them. So I can't really give you any advice on that.
All right, thank you. Our second question is, which discounted cash flow analysis tool do you use to value a stock?
I use two. I use the free cash flow to equity, and then I also use the dividend cash flow and the problem with cash flow analysis is the terminal value, the year 5. What you assume will be the cash flow in year 5 can cause a huge variation in the present value of a particular stock. But I use both, and then as a sanity check, I will check it against what the investment community says is the value of that particular stock. For example, Morningstar has what they're called their 5-star rating. If you go to Morningstar and you look at their 5-star rating, that's the deepest discount price that they think that the particular stock should be bought at. So I use that as a threshold. And then I may look at Seeking Alpha. I may look at some of the analysts there to see what they're doing too as well. So there's no one number. You just kind of have to look at the range and see. I tend to be very conservative, and so I tend to go close to as low as possible as I can. And I look to see if there's a bottom forming in the stock, and then I'll buy it.
Got it. And someone mentioned there's a site called valueinvesting.io. I don't know if you've heard of that or have any opinions about that site.
Yes, I do. I use value investing. I think it was mentioned in my presentation.
Okay, got it.
Yeah,
Perfect.
it's an excellent site. I use it every day.
All right. Could you expand on how you handle RMDs with your dividend allocation? And do you handle non-retirement versus retirement accounts differently within the dividend allocation?
What I do is I generally put the MLPs and the REITs in my tax exempt account. And the reason for that is because MLPs and REITs pay income, pay their dividends, and those are not qualified dividends. They're dividends is ordinary income, and so they're taxed at your normal rate. Let's say if you're in the 24% bracket, you would be taxed on those at the 24% level, and then your state adds another 10%. So you're talking about 34%. So I tend to put those in my tax exempt account, whereas the dividend portfolio is more in my non taxable, or my taxable account, basically.
All right. There's another question that says, can you explain more on how to achieve a sustainable yield on cost?
Well, if you buy a dividend stock and the dividend grows at a regular basis, then your yield on cost will go will go up. There's an analyst, excuse me, that analyst who talks about, let's say you buy Procter and Gamble and it pays a 3% dividend, but the dividend grows at, let's say, 5 or 6% per year. When you get out to that 10th year, let's say, then your yield on cost is about 10%. So, but the assumption is that your dividend is growing every year, year in, year out, as you reach that 10-year period. So in other words, the best time to buy a dividend stock is when you're in your 50s, okay? And so if you buy a good solid dividend stock in your 50s, by the time you reach retirement, your yield on cost will be somewhere around 10%. And that's very, very, and of course, you don't take any money out of that dividend. You reinvest the dividend, of course, during that period of time. So it's an ideal vehicle for people that are approaching retirement, say they're in their 50s. That can be a fantastic deal if you pick a very conservative company, Johnson and Johnson, or Procter and Gamble, or Hershey's, or whatever. These companies, they will pay their dividends on a regular basis, and year in, year out. Any of the aristocrats are a good deal. That's why SCHD is such a fantastic ETF. Yeah, go ahead.
Thank you. There's a question about the way that you approach your portfolio, whether someone else can take over for you when you need them to.
Yes, I have it structured. To be perfectly honest, there's two parts of the portfolio. One part is fixed income, and what I did there is I have an account at Schwab, and what I do is I said, okay, Schwab, the fixed income portion of the portfolio, I would like you to manage for me, because doing bond analysis is a lot of work, to be perfectly honest. And so I said, well, let's negotiate a fee for that. And so they came up with a servicer that does that bond portion of the portfolio. So now that's already established. I did that about a year ago. Okay. So now if something happens to me, whatever, I can easily say, okay, take over the other part of the portfolio, and they can do that fairly quickly. And I've done all the evaluation on their advisor. I hopefully, they'll do a good job. They tend to be right down the middle of the road. They don't tend to be too far to the left or too far to the right. They're what I would characterize them as probably the S&P 500 in terms of their growth rate. So, for a legacy of portfolio, that's probably okay. And so I'd like to obviously have them do better than that, but that's very difficult to do. So,
Thanks, Andy. And then there's a question about anyone using TurboTax. Have they noticed that it does not separate qualified dividends from regular dividends?
No, I think it does. Um, I That's a good question. I don't think as far as I know, when you get a statement um from your brokerage house, it will tell you which dividends are qualified dividends and which ones are not. Your 1099 will tell you that. As far as I know, yeah. I use
Okay.
TurboTax all the time, and it's it does that fine. I don't think that's an issue.
All right. Well, thank you for that. My husband does the taxes, so I don't know that question. But there's a couple of more comments and a couple more questions. The first comment is Simply Safe Dividends is a good tool for evaluating dividend paying companies. It rates safety of dividends and provides warning of any risks. I don't know if you have any comments about that.
Yeah, a lot of my friends use Simply Safe. Yeah, it's good. It's a good approach. Yeah, I just don't use it. Um, they if you don't want to spend the time doing the analysis yourself, Simply Safe is an excellent choice.
Got it. And then the other comment was someone sharing their investment philosophy that they don't buy stocks solely for the dividends because some of the folks with high yielding um, dividends might be kind of, uh, not worthy of investing in. And they gave, some examples, but I don't know if you have any thoughts on how to avoid the dogs.
Yes, that's correct. There are dogs in the dividends. That's right. Um, the free cash flow is the primary vehicle. In other words, you look at the free cash flow and you want the dividends to be less than the dividends and the buybacks be less than 50% of the free cash flow. That's a rough rule of thumb. So yeah, if the free cash flow takes a dive for whatever reason, then that's a flashing red light. You need to take a look at the stock and say whether I want to continue holding it or not. Um, yes. So buying a stock where the dividend is say up to 9 or 10%, that's that's not going to happen. That's just not going to long term. That's not going to occur because what happens is everybody rushes to buy that stock. The stock drops in price, so uh, it's not sustainable. Let's put it that way. So buying a high dividend stock is just waiting for something to happen, a problem to happen. Because let's face it, if you if your risk-free level of investing is, let's say, 4%. In other words, you can buy a bond, a 10-year bond at 4%. Why would you want to buy a dividend stock that pays 10% when that risk parity is huge? there's what's called a risk premium, equity risk premium that we could go into. It's a totally another subject that tells you exactly how much risk you have in a particular stock. And that risk premium is very, very important. It's basically the discounted cash flow that is that a company does. When a company starts a project, they go through all this discounted cash flow. They do basically a hurdle rate, and that hurdle rate is what's called the weighted average cost of capital. And so you need to know what that is for the company.
So the last question I have here is, may we email you, Andy, for additional questions?
Yeah, sure. You can. It's Andy Profit, uh, number 9, the number 9 at gmail.com.
All right. Well, thank you.
We have some questions here
Yeah, sure. Okay.
that I'd like to convey to you from our current attendees. One actually asked about the handout materials. Now, this was a recorded presentation that we just played that Andy did. So in terms of handout materials, I don't know if you make those available, Andy, or if you're
Yeah, I think we can do that. John, what I'll do is I'll forward you the PowerPoint presentation, and it has attached to it the reference materials on the back. So we can put that on the site somewhere, and then people can download the PowerPoint or just the slides that have the reference material. Yeah, I can do
Okay.
that. I'll do that tomorrow.
That's great
Thank you.
because there's a lot of good content, detailed content in that presentation. The next question I have is, and they're asking about bonds as a counterpoint. I know your presentation was about income-oriented stocks and dividend growth stocks today, but this question is: traditionally, bonds are supposed to provide a ballast against volatility of equities, but this hasn't really been the case for several years now. My corporate treasury, as well as California muni bonds and funds, have performed really poorly compared by volatility, when measured by volatility. So my question is about your view of fixed income strategies for the intermediate term, say 2 to 5 years, outside of your dividend producing equities, because I think you mentioned you've got bond portfolios and equity portfolios, Andy, to elaborate.
Yeah, that's another 2-hour presentation.
We can do that in the
I,
future.
the bond portion of the portfolio is managed by Schwab, basically. And I have had that portfolio for the last 7 months, no, excuse me, 12 months. 12 months. Coming up on August, I think is 12 months. And you're right. Some of the the yield, the bonds themselves have gone down in price. But again, I'm interested in the income, not necessarily the price of the bond. In other words, I will hold the bond till maturity, or my heirs will do that. So I really don't care about the price of the bond right now. What I'm more interested in is the stream of income from the bonds. And yeah, you have to be careful about that. In fact, I'm coming up on a chance to meet with the bond investors, excuse me, the bond analysts. And one of my questions to them will be, well, what about inflation? Because everything I see that the government is doing with this tariffs and so forth, that's got to be inflationary. That's just got to be. So inflationary protected bonds might be a good strategy. So my question to them will be, well, what are we doing in this particular area? Are we going to increase the portfolio portion, which is inflation protected bonds? And that's a definite thing that I think is going to happen. So that's all I can say about it. I really don't have much more to add.
Okay, thank you. Andy, another question we received is, is how do you factor in stock buybacks in your dividend growth investing model and taking that into account in your, I guess, internal rate of return calculations?
Well, it's a very tedious process, to be perfectly honest. Fast Graphs and also Value Investing IO have a line item where you can insert the how much the company is buying back in stocks or buying their stock back. And so that would adjust the discounted cash flow back to the to the source. And so yeah, it's a fairly complicated process, but it can be done. Not many companies are doing buybacks when they're at this level of maturity. In other words, mature companies don't generally do a lot of buybacks. At least I haven't encountered too much. There are a few that do, but not many. At least in my experience has been. Could be perhaps. Yeah. So that's all. Basically, you have to do the math and you have to do the spreadsheets. There's no way around it.
Right. Another question, Andy, is if you're in the distribution phase of your retirement assets, do you attempt to reinvest any portion of the dividend receipts? If so, do you do that in all of your individual stock positions? You mentioned you had 25 or 30 in your portfolio, or do you just do it in a fraction of your portfolios? A fraction of your positions, I should say.
I I do not reinvest the dividends for any of the stocks, period. So that builds up a cash portion of the portfolio. From that cash portfolio, I will buy more of the same stocks or maybe buy some new stocks. And then the rest of it is available for living expenses. That's a simple, I try to keep it as simple as possible. I'm not sure if that answers the question, but yeah,
I
that's
think
what I
so.
do.
Do you do that in your funds like SCHD and as well as the same
Yeah,
procedure?
yeah. The
Okay.
SCHD pays me a dividend, and I just take the cash from the dividend, and I will use it as a part of my living expenses and my buybacks or my buyback. So I don't have a specific policy for buying a particular stock back, unless it declines quite rapidly, and I think it's undervalued. For example, Becton Dixon, which is a pharmaceutical company that makes the syringes.
Mhm.
They're going to split that company into two parts. The price of the stock has come down dramatically. So that might be an attractive opportunity in disguise. And so I'm kicking the tires on that right now, trying to figure out if I'm going to buy some more of that. So.
Okay. Since if you reach a point, or perhaps you have, this is another question, where you have enough income from your portfolio, do you channel any of your equities into more growth-oriented strategies that might be more tax efficient? Or do you pretty much stay with the portfolio of all um, higher dividend oriented stocks?
Yes, I have some portion of the portfolio which is in some growth stocks. For example, Microsoft. I used to have Intel, which I've sold a long time ago. Some of the tech stocks which have high growth opportunities.
Mhm.
Yeah, there's sometimes I'll do that. Yeah, but not, you know, I because they don't pay much in the way of dividends, so I limit that to a fairly small portion of the portfolio.
Okay. One of the questions was about because you mentioned a pretty healthy list of newsletters that you subscribe to, which makes sense. You've got multiple sources of good investment ideas. But one of the attendees asked about, that's a lot of newsletters. Is there much overlap between them? And do you tend to see many of the same ideas surface from the multiple newsletters? And are there a couple that, if you had to limit it to one or two, would
Yeah.
be your top picks?
If you put a gun to my head, let's see. Well, I am right now, in fact, this is one of my little projects, is that I'm doing what's called a portfolio optimization approach to the portfolios. And so what I've been doing is I've been taking, let's say, the AAII dividend newsletter portfolio, and then the Morningstar portfolio, and then the Kiplinger portfolio, and I've been looking at them from a point of view of how would I optimize those if I were to do a mix. And one of the things I've noticed, and the jury is still out on this, the dividend newsletter from AAII has done fairly well the last 10 years or so. But I would say the last 2 or 3 years, it's not performed very well at all. And so I have some questions about the portfolio, the choice of stocks in that portfolio. I don't buy just I don't buy the portfolio. In other words, if Morningstar says here are the stocks that we recommend, I don't necessarily buy all of them. I only buy ones that I think that are undervalued, and so I do my own cash flow discounted cash flow analysis. And if I think it's cheap, then I'll buy it. And if it looks like the earnings are going to grow, so yeah, to do an evaluation on the performance of a particular portfolio, let's say from Morningstar or from Kiplinger or from let's say AAI dividend newsletter. Yeah, that's something I'm working on right now. And so far, I would say if I had to rank them, I would say the Value Line one is pretty good. I'd say that's probably my first choice, followed by Morningstar, followed by Kiplinger, and then the AAI dividend newsletter would be at the bottom.
Okay.
Now, that's today, who knows what it'll be tomorrow.
Sure. One of the questions that came up, Andy, was uh, asking if you use any closed-end funds at all, or if you stay away from them because of the leverage, or are there other reasons you might use or not use closed-end funds as part of your portfolio?
Some of the holdings are closed-end funds.
Okay.
And in fact, on the bond side, there are several closed-end funds.
Okay. Any sort of parameters on those that you look for, or that are attractive or unattractive in CEF?
Well, for the fixed income portion of the portfolio, I would like to see somewhere between 4.6% yield and about 8% if I can get it. So if the closed-end fund is within that range, then I'll kick the tires on it and take a close look at it. So yes, the closed-end funds are a vehicle that I would consider. Yeah.
Okay, that's good to know. Let's see. I think we covered all the questions that were in the Q&A section. If anyone else has anything they want to ask before we close out, this would be the time to mention that. You can speak verbally if you'd like to. But we've covered a lot of good ground here, Andy. And one of the things that I thought of during your presentation was you talk about the some of the reassessing the individual holdings in your portfolio. You know, perhaps as many as 4 times a year or something. Perhaps we could have you back to talk about some of those holdings at least once a year to tell us what you're looking at. But and other topics as well. Of course, love having you back since you founded the group, and thought your presentation was excellent today. And also wanted to so thank you for participation both live and in recording. And I also like to thank Gilbert Ho for his presentation he does monthly with us, and also John Wong's excellent work as our webmaster. So just to close out the meeting, you know, I think August 21st would be our next potential meeting, and we'll have some information out on those. We're also going to have some articles that that have kind of follow-up discussions on some of our previous speakers that we're going to be putting on our site. That's the AAII income and cash flow site that's under the SIG group for category for the AAII community. So watch for those as well for ongoing communications. And thank you everyone for attending today. Really appreciate that. And we look forward to seeing you on future meetings. And again, thank you to both our presenters, Andy Profit and Gilbert Ho. Thank you very much.
Todd, thank you very much for having us.
Absolutely. Pleasure to have you. Thank you very much.